Hey everybody, Tad Stevens, CPEthink.com here. Thank you for attending today's webinar. A couple of housekeeping items. There are going to be 3 poll questions per credit hour. You must answer all the poll questions to get credit for the webinar. If for a technical reason you can't answer the poll, just do so in the chat, or just say, hey, I can't answer this poll in the chat, and we'll note that, and that will do. There will always be at least one person working the chat. Most of the time there's going to be 2. So please ask questions as we go. We'll answer them either as we go, as soon as we can, or at the end of the webinar, depending on the presenter. To get your certificate of completion, you will take a 1-question final exam from your My Courses area, just like you would a normal course. Before the webinar is over and shortly after the webinar is over, it will look like this on your My Courses page. And then within 30 to 60, sometimes 90 minutes, we will update our system from the webinar provider, and it will look like this. So after that, you would go over here and click one of the icons under the Take Exam column. It will start your 1-question final exam. Answer true that you attended the webinar. Submit the exam for grading. Answer all the NASBA feedback questions, please. Click Next. Click OK. Yes, submit the exam for grading. You will be returned to your My Courses page, and you will see that this column has changed to Exam Passed, and you can click one of these icons to get your certificate of completion. If you have any questions, just click the chat bubble down here in the lower right. Click Send Us a Message, or sometimes it'll say Start a Conversation. Just enter in whatever you want to enter down here. Click the red arrow and it will contact us, and we should answer immediately, but we usually answer within 5 minutes, always within 30 minutes, unless it's off hours, and sometimes we'll get back to you as soon as we can. So thanks again for attending the webinar. Have a great rest of your day, and let us know any questions. Bye.
Hi, and welcome to this webcast on analytics for acquiring and retaining customers. Every business obviously needs to acquire customers, but it's a long and usually expensive process. So the longer customers can be retained after they're acquired, the more profitable the business can be. This is certainly true for subscription businesses, but it's also true for every business that relies on repeat sales of the same product, or upselling, cross-selling customers on other products over a longer period of time to really drive their success. So in this webcast, we'll review the KPIs, the retention metrics, customer segmentation techniques that can be performed or generated using the accounting data that most businesses, including small businesses, already have to better inform revenue operations, sales strategy, marketing efforts, etc. So we'll spend our time learning how to generate and interpret these KPIs. Some examples include customer acquisition cost, customer lifetime value, or LTV, churn rate, net revenue retention, and a smart advanced customer segmentation technique or method. And then we'll consider ways to share these results with the broader team, so not just inside accounting and finance, but across the rest of the organization. By way of a quick introduction, my name's Brian Sudoff. I'm co-founder and CEO of Tally Street. Tally Street is built for small businesses who want to grow and get paid by using customer insights to help them anticipate problems before they happen. And the inspiration for Tally Street really comes from my own prior experience. Most of my career was spent in data analytics, big data, data networking. But then 4 or 5 years ago, I left that and started a more traditional company, and quickly started to miss the tools that I was used to having in more venture capital backed kind of technology companies. So again, Tally Street is an effort to bring these kind of metrics to other businesses, and something that I've been working on for many years before and during Tally Street. So let's jump right in. Bain & Company has been doing research for years, actually decades, about a loyalty economy. Peter Drucker said that the purpose of a business is to create and keep customers. And research has shown that those companies who can create a more loyal and happy and satisfied customer base, measured, for example, by something like the Net Promoter Score or high satisfaction ratings, grow revenues 2.5 times as fast as their industry peers and return much more money to shareholders. Even with that being true, a lot of companies today still focus more on acquiring customers rather than shifting some of their efforts to retaining customers and driving that loyalty. And again, that's what we're really going to drive into. If you look for early places where this successfully happened, the software as a service or any kind of subscription business is a great example. So think of DocuSign or QuickBooks or even Netflix. But the loyalty economy broadens that beyond subscriptions. So again, even though a lot of the metrics we'll talk about today were really kind of refined or perfected inside a SaaS business or a subscription business, they're applicable to any B2B company or B2C company that's derived or driven by repeat sales. So the way business success has been measured has changed over time. Modern accounting was introduced in the late 1800s. Think cost accounting, financial ratios, financial statements, P&Ls, cash flow, etc. And then in the 1970s with Milton Friedman, the focus really kind of shifted to driving shareholder value. The idea being that as long as shareholders were getting increasing value, then the company was successful, and the focus of the company was really to drive shareholder value higher. What's happened over the last 10 or 20 years is a shift to customer value. The focus on delivering satisfaction, good products, services to customers, and if those customers are loyal and if they're retained, good things flow to the rest of the organization, and you'll see the boost in shareholder value. As an example of that, more research from Bain is that increasing customer retention rates by 5% increases profits by 25 to 95%. This was done by Frederick Reichheld, who's a best-selling author and well-known for his research into this area. He actually invented the Net Promoter Score. So anytime you're asked how likely you are to refer a product to a friend, you can thank Mr. Reichheld for that. The reason this dynamic exists, of course, is again because it's expensive to acquire customers. So the longer you can retain them, you recoup that acquisition cost, and each additional sale is just contributing more and more to the longer-term profit of the company. And again, not just for SaaS businesses. My business before Tally Street was a liquor distributor. Certainly not subscription-based, but I relied on being on the menu in a bar or a good place on the shelf in a store. And those repeat sales are really what drove the profitability of my business, which is why the same metrics are still applicable here. So businesses can really thrive when everyone focuses on customer value, and the obvious question then is how to measure that customer value. And the best measurement is the lifetime value that customer provides or generates during their time with the business. Lifetime value and how to increase and maximize lifetime value is really approached by having better customer insights that help the business make decisions to help them keep and retain those customers over a longer period of time. Another benefit of boosting retention rates and really knowing your customers is it makes the business more predictable. If you know that you can retain a customer for a certain amount of time and you can estimate how much you will sell that customer over that time, it's again much more straightforward to predict the revenue that you expect to get from the existing base of customers and then have assumptions on revenue from layering on additional customers. Also, the same customer insights can help better predict or estimate incoming cash flow, for example, by knowing which customers pay more quickly or what changes to policies, invoicing policies can encourage customers to pay more quickly. And then lastly, really we want to align or create alignment between sales, marketing, and finance. Traditionally, each of these groups operated kind of siloed. Maybe they had an operations team which was also siloed. What we really see is the emergence of a function which is now more often being called RevOps that brings these groups together so they can all work from the same single source of truth and that their activities and their priorities are further aligned. So when we look at those customer insights or customer intelligence, Kind of the traditional ones that are used in accounting are, again, financial statements, looking at financial ratios, with more of a customer focus, sales reports or aging statements to track payment performance. But the newer customer insights that we're going to review today and have become increasingly important are looking at customer churn or retention, again, customer lifetime value, concentration risk from maybe selling or having too few customers constitute or make up too much of the company's sales. And then more sophisticated efforts or methods are to look at things like behavioral-based segmentation. So to group customers by how often they buy or how much they spend, or in the case of payment performance and risk, how well they pay, essentially how much you have to lend to them or offer them as a kind of a discount for driving those sales. So let's start with an introduction to CAC and retention. CAC being customer acquisition cost, and on retention we'll look at both revenue and customer retention. So this is a bit of an exaggeration and hopefully a little humorous, but this kind of shows why acquiring new customers is so expensive. It's a complicated process, lots of different marketing channels, lots of salespeople, onboarding procedures, etc. So a lot of work and effort goes into acquiring new customers, and it's expensive. Keeping customers, while not quite as simple as this chart suggests, is a little more straightforward. You already know a lot about the customer. You're already engaged with them. So the longer, again, you can keep those customers, the more profitable the business can be. And here's a chart that really captures that. So the customer acquisition costs are those costs spent up until the point the customer was acquired. Once the customer is acquired, which we usually define as making their first purchase, signing their first contract, you start to whittle away at those costs. Not all businesses recover the cost to acquire a customer in the first sale. It might take 2, 3, 4 sales to recoup the cost spent to acquire customers. So the longer the customer can be retained, the more profitable the business is, especially after they've recovered, or not especially, definitely after they've recovered those initial customer acquisition costs. This is a graphical representation of why a 5% boost in customer retention can drive 25% or 95% increase in profits. But customer retention is not the only way to look at retention. Another very useful metric is revenue retention. So instead of looking at how many customers were retained from one period to the next, revenue retention tells you how much revenue was retained from one period to the next. And if a business can increase revenue retention, the impact accumulates over time, much like, say, interest rates. So each boost in revenue retention carries forward to the next period, the next period, the next period, which is why you see this chart on the left, that an increase in revenue retention from, say, 95% to 105% can lead to a substantial increase in overall revenues over a 2, 3, 4, or 5-year period. So one place I like to start first is kind of level setting or reviewing the types of customers, some basic customer definitions. When doing analytics work, some of these details matter, so let's quickly kind of go through them and make sure that we're using the same terms afterwards. So first are new customers. A customer is only new, or a customer is new in the time period when they first buy from you. So if you're doing a report on the last month, the last quarter, the last year, new customers will be any of them that were acquired or made their first purchase during whatever period you selected. Obviously, a new customer can only be new one time. After that, they'll be a repeat customer, or we have different segments of repeat customers we'll get into. But a kind of a catch in analytics is that a customer can be new and repeat in the same period. So go back to that example. Let's say you're looking at your new and repeat customers in 2020. You'll have the new customers who first bought from you in 2020, but if they bought again in 2020, they're also a repeat customer. Just something to be aware of and make sure you're not double counting when producing statistics and doing analysis. So repeat customers are quite simply just customers who have purchased more than one time. Um, it could be 2 times, it could be 10 times, it could be over different periods. So it's very helpful to segment these repeat customers into different groups, which we'll go into right now. So the first segment that's important, especially as we start to look at retention metrics, is retained customers. So we define a retained customer as not only a repeat customer, but a customer who repeatedly purchased or repeatedly bought in a regular interval. What that regular interval is will vary by business, but that's how you define the retention period. So if you look to customers to purchase on an annual basis, then customers who repeat year to year will be retained, defined as retained customers, but they're also part of your larger set of repeat customers. So that raises the question of what's a retention period. So the retention period is the time period in which customers typically make another purchase. This will vary a lot by company. If you take the example of a, say, a SaaS business or any company that has contracts with all of their customers, your average or typical contract duration will probably be your retention period. So if customers pay for a year up front or contract to use a product or a service for a year, you'll have a 12-month retention period. For those businesses that don't have contracts or don't have subscriptions, another way to look at retention period is just to go back and average or look at the median or the average of how often companies buy. So if a bulk of customers typically buy within, say, 3 months, then maybe you look at a quarterly retention period. Or if it's within a year, then you go back to looking at an annual retention period. Now, customers who are not retained are referred to as churned. So churned customers are those who did not buy again during or within a retention period. So for example, if a customer purchased in 2019 and did not buy again in 2020 with an annual retention period used for analysis, that customer would be considered churned in 2020 when they didn't re-up or buy again. You'll also hear churned customers referred to as lost customers. And just a quick note, they could have been a churned customer, could have been a one-time customer, so they were new in the prior period, or they could have been a customer for years. So churn is just capturing really those customers who were lost in the period in which you're doing analysis. Now, even though a customer is churned and falls into that churn metric, they could eventually come back. So to our example, if a customer bought in 2019, did not buy in 2020, but then did buy again in 2021, they would have been new in 2020, they would have churned, new in 2019, they would have churned in 2020, and in 2021 we would call them re-engaged. So it's really just a special category or segment of repeat customers that is really helpful to measure to look, for example, at the return on investment of some of your marketing efforts. So if you have a campaign or an effort to win back or reacquire customers who were previously lost or churned, then you'll want to track the re-engaged customers. So just to quickly review the customer types, the basic ones we have are new customers. Again, the customers are only new in the period in which they first made a purchase. A repeat customer is any customer who buys a second time, a third time, or any multiple of times. Retained customers are those who buy repeatedly within a retention period that's defined or set by the business. And the opposite of that is a churn customer, or one who is lost or does not buy again during a retention period. And then lastly are those who are re-engaged, reacquired, or won back. It's those customers who were churned and were lost, but later came back and bought the product or service another time. So with those basic definitions, Let's move to key company and customer retention metrics. The first we'll talk about is CAC, or customer acquisition cost, the red area we saw in the chart in the beginning. This is the average cost to acquire a customer. CAC, what goes into CAC will be a little different for every business. Generally speaking, it's the sales and marketing expenses that you can allocate to customer acquisition, and then just divide that by the number of customers acquired. So if you were looking at CAC over the course of a year, you might add up your sales salaries, marketing salaries, cost, trade show cost, etc., and divide it by the number of customers acquired during the year to get the average cost to acquire a customer. The objective, or how much should be spent, how much is kind of strategic or reasonable or good target for CAC, is maybe best thought of as not a number, but as a ratio. So usually what you'll do is think of CAC, or put it in the context of how much revenue you expect to get from a customer during their lifetime. So for example, in the software as a service business, you typically look for, or a good success metric, is that the average total sales that we'll ever make to a customer should be 3 times larger than what we spent to acquire the customer. You might think that a higher ratio, say 4 to 1, 5 to 1, 6 to 1, could be better, and in some cases it might be, but in other cases it might suggest that you're under investing in acquiring customers and that you have room to spend more on customer acquisition to really drive revenue and growth of the business. Next is lifetime value, customer lifetime value, which is often abbreviated as LTV or CLV. And customer lifetime value is one of the most important metrics to track for any company. Again, if we think back to that customer loyalty or customer value slide, this is how you really measure. This is the top line measure of how valuable a customer is. And the lifetime value is the total revenue a business has or can expect to have from a single customer. And you could look at the LTV of any one customer, or average LTV across all customers, and again compare that to customer acquisition costs to make sure that you're spending a reasonable amount of money to acquire new customers, given how much you expect to eventually sell to those customers. So we talked about customer retention. Churn rate is, you'll often hear more, which is just the opposite of customer retention. So churn rate is the percent of customers, again, who were lost during a retention period. So those who bought in a prior period but did not buy again during the most recent period. Again, they're considered lost because they stopped buying, and the way you calculate the churn rate is just to add up the number of customers who did not purchase in that retention period, so they weren't retained from one period to the next, say 2019 to 2020, and then divide it by the total number of customers in the prior period. So for example, if you had 100 customers in 2019 and 90 of them bought again in 2020, you have a 10% churn rate. A useful thing to do once you have the churn rate is to use that to estimate the amount of time that you can expect to have a customer. So that can be done by taking just the 1 divided by the churn rate. So as an example, if a company has a 20% churn rate, so if they had 100 customers and retained 80 of them, then that means they had a 20% churn rate. Then we would expect a new customer to stay with us for an average of 5 years. And that's simply 1 divided by the 20%, or 0.2 equals 5. So the real usefulness of knowing the churn rate, first of all, it's a huge drain on the success of a business. But if you know the churn rate, and then you can estimate the lifetime value, if you know the churn rate and then you can estimate the lifetime of a customer, then we can estimate the lifetime value of a customer. Now this is particularly valuable for any business that is growing or growing through changes and maybe historic lifetime value is not very representative of what they expect. So knowing the expected lifetime of a customer, and if we know the average kind of revenue we expect to get from a customer over any particular period, then we can estimate the lifetime value of a customer. So there are two ways to do it. Using the churn rate is the more sophisticated method, and again, that's taking the average revenue of customers per retention period divided by that churn rate. A simpler way to do it, if you don't have that metric yet, is to just look at the average purchase value across your customers, and then look at the number of times you expect to sell to a customer. Knowing expected LTV, again, especially in a growing or quickly changing business, is really critical information to have, provides critical decision support for sales and marketing, spending, etc. Again, because of CAC. So if you can estimate that the expected lifetime value of a customer is $10,000, then you might be very happy to spend $3,000 acquiring a new customer. Now, we mentioned churn has a big negative impact, a big downside for a business. And here's an example or a simple illustration of how lowering churn really can drive profitability and performance at a business. So let's take a business whose average sales to customers are $10,000. And let's say they had an annual churn rate of 30%. We know from dividing 1 by 30% to estimate the lifetime that they therefore can expect a business to be retained for about 3 1/3 years, which means they would sell that business a total of over $33,000. If the business could lower their churn rate from 30% to 25%, the average lifetime of the customer goes up to 4 years. If they still spend $10,000 a year on average, we're now at $40,000 or almost an extra $7,000 from each customer that was acquired. And again, maybe spending the same cost to acquire them. So much more of that $7,000 flows directly to the bottom line. If the business had 300 customers in total, then that's an extra $2 million we would expect that business would expect to have in sales and revenue to the same set of customers by lowering their churn rate. So again, lowering churn really has a huge impact on the long-term success of a company, decreases the amount of time and effort you have to spend acquiring new customers, and boosts the lifetime value that you have from customers who were acquired. Customer retention is really the opposite of churn, or the churn rate. So customer retention rate is the share of customers who were retained from one period to the next. So as an example, if a business had 500 customers last year and then sold to 400 of those customers again this year, they would have an 80% customer retention rate. And again, customer retention is just the flip side of churn. So the same business has a 20% churn rate. Obviously, you cannot do better than 100%. So if you retain all your customers, you have a 100% customer retention rate. Another way to look at kind of the value of customer retention rather than the actual number of customers retained is to look at net revenue retention. So net revenue retention looks at the amount of revenue that was retained from one period until the next, instead of the number of customers. What net revenue retention basically tells you is what top line revenue would be if the business acquired no new customers. So for example, if a business had $10 million of sales last year and had a kind of steady retention rate, net revenue retention rate of 90%, then if that business stopped all new customer acquisition efforts, we would expect them to have $9 million of revenue this coming year. So it really, again, tells you what a business's revenue would be if they stopped acquiring new customers. And it's the base revenue that is essentially built into the business and supports the business as they look to grow into the next year. So There are a couple components to net revenue retention as we see in the formula below. The two of them being revenue expansion and revenue contraction. Revenue expansion happens when retained customers increase their spending. And that could be because those customers bought more of a widget or whatever service was being sold. It could be because they were cross-sold or upsold to other products or services. Or it could be something as simple as a price increase that causes or leads to that business to sell more from one period to the next. Unlike customer retention, net revenue retention can exceed 100% because if a bunch of businesses, if those, say, 500 businesses spent $10 million in 2019, and then the ones who retained spent $11 million in 2020, we'd have a net revenue retention rate of 110%. In fact, as again, a measure that's very popular in the SaaS world, the very best, the strongest SaaS businesses very often have revenue retention rates over 110% and sometimes over 120%. So the other component of net revenue retention is revenue contraction. Contraction happens when customers spend less over time. So these are customers who, again, were retained. They may not have gone away, but they just lowered their spending. So they decreased the quantity of products that they bought. Or they didn't buy quite as many products as they did before, but they may have still been retained. Of course, churn customers also contribute to contraction in that they contract all the way to zero. So if they spent $1,000 last year and zero this year, they alone contributed $1,000 in revenue contraction. So once you calculate revenue expansion and contraction, then the net revenue retention rate is just the prior period's revenue, say last year if looking at annual periods, plus the expansion from those customers in the most recent year, minus the revenue contraction divided by the prior period. So again, always expressed as a percentage. So we talked about how net revenue retention accumulates or contributes to the ongoing growth of a business. And let's look at an example of that. So if a business had a net revenue retention rate of 95%, and let's say it's a $10 million business, and let's assume that every year 5% of their sales come from new customers. So last year they were a $10 million business. 5% of their sales came from new customers. That means in this year, year one, we would expect them to have $9.5 million in recurring sales because 95% revenue retention rate applied to the $10 million from the prior year. And then from that $10 million, 5% of that comes in new sales. So we're right back where we started at $10 million. So essentially, if the net revenue retention rate is 95% and 5% comes from new sales, this business is just going to remain flat in revenue for the foreseeable future. If the same business could increase net revenue retention to 105%, and if everything else stayed the same, then that means from that last year to year one this year, they would get 105% of the 10 million, or 10.5 million. They would still get another rounding. They'd still get another $500,000 in new sales to give them a total of $11 million this year. So revenue retention went up 10%, and the total extra revenue was up 10%. But because that builds on itself and accumulates, when we go to year two and run through the same math, we see that they get an extra 21% in revenue, and in year three, an extra 33% in revenue above what they would have had previously. So again, that increase in net revenue retention builds on itself year after year and really provides tremendous support for a growing business. Anytime, obviously, net revenue retention is below 100, then for a business to grow, they need to acquire enough new customers to backfill for the revenue that they did not retain, as well as providing enough additional revenue to meet whatever their growth targets are. If revenue retention is over 100%, then you essentially already have new growth built into the business. So every new customer that's acquired is adding revenue to last year, and really supporting the sales growth of the company. So let's quickly review kind of the key metrics or the base metrics for looking at retention type analysis. So first we talk about customer acquisition cost, or CAC. Again, this is an average of how much time is, or how not much time, sorry, how much resources are spent to acquire customers, typically by dividing sales and marketing expenses by the number of customers acquired during the period. Then we talked about customer lifetime value, which is often abbreviated CLV or LTV, which is the amount that has been sold to customers over their lifetime, or the amount, again, that we may expect to sell to customers over their lifetime, by computing the next metric, which is the churn rate, or its partner, the retention rate. We can use those to calculate the expected LTV. In combination with those metrics, it's very valuable to look at net revenue retention so that we can see not only how well customers are being retained, but are those customers being sold more and more from year to year. So let's look at some of these results on charts. I think it's an easier way for them to kind of sink in and talk about some of the trade-offs. If you're just getting started with some retention metrics, one of the simplest things to do is just look at new versus repeat sales. So without getting into retention periods or churn rates or retention rate calculations, simply go back and look at all the customers who were sold during a period, which ones were new, which ones were repeat, and compare the two and track how that's changed over time to get a sense of how successfully the business is driving repeat sales, just as a simple top-line number. So in this particular demo or situation, we see that 94% of transactions were to repeat customers, and they contributed 99% of sales over the same period. And we can see how that's changed over time. So the amount of new sales, we had a nice spike in kind of May and June, but it's consistently been in the the $1,000 or $2,000 range. Repeat sales, however, have been on a wonderful upward trend in this short table, growing from around 150,000 back in April to close to 300,000 going into the fall. At the bottom of the chart, another thing that can be also helpful to see is track the deal size, the average deal size to a new and repeat customer. In this case, we see that new customers typically have a larger purchase. That first purchase is larger than a repeat purchase. That's not at all uncommon. That's actually what we typically see when we work with our customers. A common example of that would be a customer who buys some product. It's a large upfront expense, and then they buy a maintenance contract to go on top of that product. So while the new sale may initially be larger than your average repeat sale, again, it's those ongoing repeat sales going from 150,000 to 300,000 that really drive the long-term success of the business. Now let's look at some retention details for the same demo or sample customer. In this case, we see that they have a 12-month retention period, and we're looking at an analysis that ends with the 12 months up to the 12 months ending with August 2020. And we see that they have a 60% customer retention rate. So 12 to 24 months ago, of the customers they had 12 to 24 months ago, 60% of them bought again within the most recent 12 months. We see that the net revenue retention rate is 76%. So that's not 100%. They didn't retain all the revenue from the prior period, but at least they retained more in sales than they did in customers. First, before even getting into retention, we see their new sales. So they had 140 customers active last year. 50 of them were new, or in the last 12 months. 50 of them were new in the 12 months, and those new customers spent a total of $450,000. We see that they retained 90 customers from that prior 12 months into the recent 12 months. And we don't have the total revenue number here that those customers spent, but we do see that they so they continue to spend money, but they spent about $556,000 less than they did in the prior year. And in addition to that, we had 61 customers from the prior period who didn't buy again at all, or so who were churned or lost. And they represent a loss of $258,000. So given that we have revenue contraction among the customers who were retained, and obviously we have revenue contraction among the customers who were completely lost, it's not surprising that the net revenue retention is below 100. So that's a snapshot of one particular period, but it's often more helpful to look at how a business has trended over time. So at the blue line at the bottom, we see the customer retention rate for this period. The 60% we saw is actually not a bad number for this business. They've been hovering just below that pretty consistently for the last year or so. On the other hand, the 76% revenue retention is not really a great number for this business. So they previously had revenue retention rates up around 90%. Now 2020 was certainly a very unusual year and a challenging year for a lot of businesses, so it's not surprising to see a chart like this, but it still helps to look at these numbers together and understand how they might kind of impact each other or what they would cause. So in this particular case, again, we see that the customer retention rate has been relatively flat, while net revenue retention rate was down. If this were to continue, what this would mean is that this particular business would need, if they wanted to grow top-line revenue, they would have to keep acquiring more and more customers every period in order to make up for the revenue they lost, not only from the customers who left them, the 40% who were not retained, but the customers who were retained that just simply spent less money. One quick note actually before we move on to the other slide. We often see companies, or you hear about companies, where they're growing well, revenue is climbing, and then suddenly they plateau. This, if you look at these charts, this is often a reason that contributes to them that surprising plateau, and it's because they weren't tracking revenue retention closely enough along with customer retention. So here's another example, and what do we see in this case? We see that both lines are up and to the right. So customer retention has increased from 40% to 65%. At the same time, net revenue retention increased to over 100%, which is just amazing and a wonderful thing to see, right? So this business is doing really well. They figured out how to retain more and more of their customers, and they figured out how to sell the customers they did retain more product or more service, which will support their revenue growth into the next period and into the next period. So now that we went through some of the basics, or the kind of the initial set of customer retention and revenue retention metrics and how to kind of track them and read them on a chart, let's spend a little time going into some more detailed or some richer ways to look at customer performance using many of the same metrics we just reviewed. So one of those, what analysts will often call, is a method that analysts often use, is segmentation. So if we segment our customers, we're basically taking all of our customers and dividing them into groups. Businesses have been doing this a long time based on what's often called firmographics. So how many customers have fewer than 50 employees or more than 200 employees, or how many are in the Northeast versus the West Coast. Another way to look at customers, in addition to that, is on their behavioral characteristics. And that's what we'll focus on in this section, is grouping customers by their patterns of buying, repeated buying, lifetime value, etc. So the four characteristics that we use to behaviorally segment customers this way are recency, frequency, monetary, and timeliness. This model, the tally street that we use, we call RFMT. It's really an extension of RFM, which is a model that's been used for a while in the marketing world that looks at recency, frequency, and monetary. But we apply it to accounting data. So recency is how often customers bought. Or sorry, recency is how recently customers bought. So did they buy in the last month, the last 6 months, the last year? Frequency is how many times they've purchased during their lifetime as a customer. And monetary is how much they spent, essentially their lifetime value. So how much they've spent during their entire time as a customer. And then because many B2B companies sell on terms, we want to include timeliness. So also measure how quickly companies paid for the services or the products for which they were invoiced. This is, this kind of method or technique is not something that's easily captured in a formula, as we saw with revenue retention or customer retention. We use statistics and machine learning to basically grade customers on a curve. So to look at all customers and then relatively kind of stack them, cluster them, rank them based on how recently they bought, how frequently, how much they spent, and how well they paid. And the result is a grouping of customer segments or opportunities or risk that a business can use to design better customer acquisition strategies, and then also use to drive their customer retention efforts and strategies. So again, AI, machine learning are great tools to do this. They'll crunch a lot of data. Our software crunches a lot of data very quickly, automatically groups the customers into these categories. A segment like champions will be those who have probably been customers for a fairly long amount of time. They've spent a lot of money, they buy frequently, and they pay well. Promising customers might be newer customers who are on a good path, a good trajectory, and hopefully will become good or champion customers over time. When we get to the don't lose them or give attention category, really what you're flagging there is churn risk. So if you think back to the churn rate and churn customers, what you're trying to accomplish with the don't lose them or the give attention segment is to identify customers before they churn, so that your customer support teams, your account management teams can go back and engage those customers and hopefully retain them and prevent them from completely churning. Hibernating customers we use to kind of describe those who maybe they are lost and maybe they are churned. It doesn't mean you'll never get them back. So they're, we don't want to call them lost, but just kind of away for a while or asleep. But hopefully some marketing win-back effort will eventually recapture, reacquire those customers. Mismatches are a really important category because mismatches are those customers who looked like they were a never good fit for the business in the first place. So if you think back to customer acquisition cost, it's very helpful to avoid spending time and effort acquiring customers, obviously, who are going to be mismatches and maybe never generate enough sales to recoup the money that was spent acquiring them. And then we had a special category for late payers. The late payers could be champions. They could be churn risk. They might be in another category if only they paid well. But these are the customers who just constantly pay late. They're kind of the problem children that the business can then focus on improving those collection efforts from those customers. And we'll have another section actually on those collections KPIs. So this table really pulls together a lot of what we've talked about in this entire session at a segment or customer group level. So we see all of our different segments, we see how many customers are in each segment, and we see the average lifetime value of each segment. Not surprisingly, champions have a much higher lifetime value, more than 3 times higher than good customers, many times higher than, of course, hibernating customers or mismatches. And they've also bought very frequently, so 126 times over their lifetime. And in the last 12 months, the trailing 12 months, TTM, they continue to be good customers, generating, in this case, $1.7 million of sales over that time period. And they pay well, taking an average of 18 days to pay. If we go down to the don't lose them or give attention categories, we see that those customers, their lifetime value is less. They haven't bought a lot, but 6 times is, still notable, but they haven't bought anything in the last 12 months. So if this business has a 12-month kind of retention period, then these are customers who are on the cusp of being lost or not being retained, or maybe they already have. The hibernating customers are those who have been lost or not purchased for a much longer period than kind of typical customers who slow down. And then the mismatches we talked about, so that's the largest category in terms of number of customers with 46 of them. And you can see that on average, they only bought one time. So these were customers who made a small one-time purchase and never came back. Not the kind of customer this business should focus on going out and acquiring more of. The late payers look suspiciously like champions, except that they take 81 days to pay instead of 18 days to pay. So their DSO, their daily sales outstanding, or their average days to pay is more than 4 times what it is for champions. That's some low-hanging fruit for the business to go after and try to boost their overall cash flow. Then we can also go in and look at each individual customer and the segment they're in, their lifetime value, their purchases, their sales, etc. This is just a snapshot of kind of 35 to 40 different characteristics that are available at the individual customer level. And these can be used, you imagine sitting down with providing this to sales and marketing working on personas or profiles of champions, and then focusing their marketing and sales efforts to acquiring more champions while trying to avoid, for example, the hibernating customers. Or in the case of avoiding churn risk, catching whenever a customer flips from maybe a good category or a champion category into that don't lose them or give attention, and hopefully jump on that customer before they completely are lost and fall away. The same information, again, can be used to align efforts across functional teams. So everything we've looked at today, these metrics, they're produced from accounting data. They can be produced by the finance department and the accounting department on their own by just mining the accounting data that they already are managing, that's already available to them. But then taking that information and making it available to the rest of the organization, again, can really align them and drive and coordinate those sales and marketing activities. So this is an example where those same customer insights or characteristics that we just saw, such as the segment, or maybe their lifetime value, or how long it's been since their last purchase, get automatically inserted into a CRM like Salesforce or maybe HubSpot. Now the sales and marketing teams who don't have access to the general ledger and the accounting data still have the information they need to prioritize their efforts for growing and retaining those customers. And here's an example of using the same information to actually trigger that action. So if a business has decided by going back and doing their own analysis and looking at the results that if a customer is away or doesn't buy for 6 months, they're at a high risk of churning. Then in the CRM, they could create a trigger so that as soon as a customer hits that 6-month threshold, a notification is sent to their sales rep to check in, right? Or the support team to check in with that customer and hopefully address whatever problem is, get more feedback, offer them some additional products, services, discounts, whatever is kind of reasonably required to help retain that customer. So a lot of the metrics we reviewed, churn rate, retention rate, obviously new versus repeat customers, you can compute all of these on your own. They're easy enough to do in a spreadsheet. If you'd like if you'd like to have it done for you, or if you'd like to try to look at some of the additional customer segmentation issues, I'd like to invite everyone to get a free report. Just go to tallytree.com/landing retention, the link on the bottom. And if you use QuickBooks, Xero, or Sage for an accounting package, the metrics we reviewed today and much more You can receive them all at no cost, and then you can compare them back to your own work or efforts that you've done to calculate those numbers yourself. So to finish on a lighter note, we hope that the next time your client, your CFO, your CRO is looking for new business, lost business, missed opportunities, that now you have more tools, techniques, analytics, metrics, in your back pocket at the ready, things that you have can produce from the accounting data that you're already managing to help the rest of the team really grow and maintain and grow and accelerate their business. And with that, I would like to thank you for the time joining us today, and please don't hesitate to reach out if you have any questions or feedback. Thank you.
Thank you for attending today's webinar. To get your certificate of completion, you will take a one-question final exam from your My Courses area, just like you would a normal course. Before the webinar is over and shortly after the webinar is over, it will look like this on your My Courses page. And then within 30 to 60, sometimes 90 minutes, we will update our system from the webinar provider, and it will look like this. So after that, you would go over here and click one of the icons under the Take Exam column. It will start your one-question final exam. Answer true that you attended the webinar. Submit the exam for grading. Answer all the NASBA feedback questions, please. Click Next. Click OK. Yes, submit the exam for grading. You will be returned to your My Courses page, and you will see that this column has changed to Exam Passed, and you can click one of these icons to get your certificate of completion. If you have any questions, just click the chat bubble down here in the lower right. Click Send Us a Message, or sometimes it'll say Start a Conversation. Just enter in whatever you want to enter down here. Click the red arrow and it will contact us, and we should answer immediately, but we usually answer within 5 minutes, always within 30 minutes, unless it's off hours, and sometimes we'll get back to you as soon as we can. So thanks again for attending the webinar. Have a great rest of your day, and let us know any questions. Bye.